Good day. I'm Martin Gago with Market Radius Research. It's Wednesday, May the 11th, and we're here to get a quick update video with CEO Dave Harper of Geodrill. Geodrill provides drilling services in West Africa, Egypt, and Peru, and Dave is here to discuss Geodrill's recently released Q1 fiscal 2022 financial results, which came in quite strong. But please remember, this is neither a recommendation nor investment advice. We're here to learn about the company. Dave, thanks a lot for joining us. And why don't you give us a quick overview on the quarter highlights?
So the first quarter of 2022 was the best we've ever had in the company's 25-year history. We generated record revenue, representing a year-over-year increase of 9%. Recall that for the corresponding quarter a year ago, we achieved a 70% year-over-year improvement. We were coming off a low base at the time. So that was an exceptional result, and therefore any increase on this is in itself also considered exceptional. Aside the top line, we also generated record EBITDA, 31% of revenue. We delivered net income of $6 million USD or 13 cents US per share. Total equity improved by a record $5.2 million or 6% on the previous quarter. And that's up year over year, 18%. All this generated a shareholder, for our shareholders, return on equity of 16%. We also achieved ROCE of 22%. And we ended the quarter with net cash, $5.6 million. Overall, it was a great quarter. We felt really strong about it. During the quarter, we paid a cash dividend of 3 cents Canadian, and we're scheduled to do the same again in the back half of the year. And if we accomplish that, we will have tripled our dividend on what we did a year ago. Overall, it was a great quarter, very solid quarter.
All right. On the growth side of the quarter, was it, you mentioned, I believe, 74% utilization rate or 75% of rigs in your news release. What was it? What drove it? Was it higher utilization rate, better pricing environment, just more rigs out in the field? Could you just summarize that quickly?
So we ended the quarter with 74 rigs, and that was up to 2 rigs over the previous quarter. Utilization on the enlarged fleet was 75%. So, and strategically, you know, whenever utilization for us hits 70%, that's the trigger point for us to go and add rigs. Yeah, but basically, yeah, strong quarter, strong utilization.
And the quarter, you mentioned that it ended very strongly, the quarter. Coming out of the quarter, it was good. Does that give any indication on how Q2 is looking to shape up?
Absolutely. So it was it was odd. Quarter one, our January was actually slow. It was a year over year, we were below, and February was flat. So for us to actually put on a 9% year over year improvement, it had to come from somewhere, right? So the majority of the strong revenue actually came in March. And so my point being, we exited the quarter with a very strong run rate, which obviously augurs very well for quarter two. Okay, so recall last year that quarter one was actually our strongest quarter. This year, the current quarter, this quarter, quarter two, will be our strongest. It'll be actually our strongest thus far in the history of this company.
All right, well, that's good. That's making the quarter look good at this point. One of the big factors everyone is talking about now is inflation. How did the inflation affect your financial results?
Well, first of all, costs are moving. Generally speaking, when we do contracts in periods of in excess of 2 years, we tend to build in a rise and fall. And so if, you know, in a formula of, you know, half a dozen indices, if certain things go out of kilter, like we're seeing at the moment with fuel and so on and so forth, then we would capture that in the rise and fall clause formula. Contracts of 1 to 2 years, we tend to take a conservative view on costs, and then we build those that, you know, conservative view into a view of what that escalation will look like. We build this into our contracts. Costs are on the move. Everyone's complaining. It doesn't matter whether you're talking about a dozen eggs or a gallon of petrol. Everything's going up. And so as a natural function of that, we're starting to see some, we're having to increase our pricing to capture those rising costs. And the trick here is to try and keep ahead of the curve so that you don't miss out. So I think we've done okay. We put in was it 26 or 27% gross margin result for the quarter. I think that was pretty good. Things don't go up in a straight line. Revenue goes up. Sometimes you'll miss a couple of things, but generally I think we're doing pretty well.
All right. What are I would think the biggest driver or expenses that your business runs is labor and diesel, and then some CapEx. Are those the biggest cost drivers on in your gross margin?
At the moment, it's a bit of everything. It's obviously labor, obviously fuel. But I mean, some things that you wouldn't normally expect, which are being driven by things like COVID and the Ukrainian situation, as we're seeing shipping costs have been very, very expensive. The cost of shipping a 40-foot container quadrupled through COVID. That is now starting to tail off and normalize. But as it normalizes and comes down, something else kicks in. All in all, we're looking at an environment of rising prices, and we've got to be ahead of the curve with our pricing. And the beauty part is it's an even playing field. Our competitors are experiencing the same problems.
Yeah. And sorry, I just looked on your financials. Your gross margin in the quarter was 29%. So,
it was 29. Okay.
Yeah.
Okay.
Yeah. So when you have you announce a bunch of new contracts, and the front end of these contracts, are margins kind of reduced as you get set up and so forth? Or is it you just got to pull the drill rig out to whatever location and it doesn't really matter if it's a new contract or an existing one? Was there any pricing pressure on all the new contracts you announced?
Well, there's a lot of bidding going on at the moment. We announced 3 very significant contracts in the early part of this year. And as a result of that increased amount of bidding, we're not the only ones out there that are bidding and securing work. I'm sure our competitors are doing equally as well. And so as a function of that, we're starting to see a bit of pricing leverage. And so we're able to capture those, those front end mobilization costs in most contracts. So this is pretty normal for where we are in the cycle at the moment.
All right. Q1 was excellent. Q2 looks like it's shaping up to be excellent. Can you just go, I believe Q3 is your rainy season quarter and kind of the weakest quarter. Could you just discuss seasonality? And I believe you guys manage your gross margins to kind of average out 25, 26% through the year with the slower seasons built in. Do I have that about right?
Yeah, so traditionally what happens is we would normally be very busy in Q2, and then traditionally what happens is around June we start to enter wet season. So typically things taper off. This year, the way I think it'll look is we just put out a solid Q1. We're going to put out a very solid Q2. Our Q3, our wet season quarter, it'll be a strong quarter. It'll be a Q over Q drop because of the wet season, but it'll be year over year improver. And Q4 is going to be solid, and overall it's just going to be a great year. It'll be our best year ever. And I think this is the beginning. The real story here is that it's just not this year. We've just come off a 6-year down cycle, and we are entering an up cycle, and the cycles tend to mirror each other either side of the parabolic. So we can say with some confidence, if we've come off a 6-year down cycle, then we'll see a 6-year or 7-year or whatever up cycle. And where this cycle is a little different to previous cycles is we're not just drilling for gold. We're drilling for gold, we're drilling for base metals, and we're drilling for EV, electronic vehicle metals. You know, I've never seen in my 35 years in this industry a situation where everything is going at once. Everything is going at once. And it's not just Geodrill. I mean, I've just come back from Australia talking to my colleague drillers back there. And everyone's busy. Everyone's busy. So it's very characteristic of a cycle and some. You know, this is going to be a cycle squared. This is looking like a super cycle.
All right. And you operate now in 3 regions: West Africa, Egypt, and Latin America, or South America, Peru. Could you just give us a quick highlight on sort of maybe how each of those regions is doing? Obviously, Peru and in Egypt are earlier stage. West Africa is where you've been operating for many years. Can you give us a quick overview on those regions?
So West Africa continues to be a very strong market for us, continues to grow, and we continue to invest and commit capital. New markets for us are Egypt and South America, Peru specifically, and those markets are going very well. So not too long into our first contract in Q3 last year, we were invited to tender on a very large underground contract at the biggest mine in Egypt, the Sakari gold mine, and we successfully were awarded that contract. The contract began in the tail end of Q4, and it began in Q1, and as at now, we're basically drilling at full capacity. So it's been a quick ramp up. The way that we've managed to do that, you might have heard on the investor call we gave the other day, where we mentioned that we had to rent some rigs to get started on the job. It was actually that particular program. We came to an arrangement with our client, our customer, where they had an existing fleet of rigs, and we have leased that fleet of rigs in order to provide a soft start to the contract so that we can get straight into production. And we will continue to rent those rigs until such time as our new rigs, which are on order, arrive. And that'll imminently occur in the ensuing months. For the meantime, we're not sitting around waiting for our rigs to arrive. We've managed to actually come to an arrangement which has put us straight into work. And
How much
as for South America, it's a different play. We looked at South America as a base metals and EV play. So it was about diversifying out of the continent and setting foot into a new continent and taking on new opportunities. And I have to say we've been very happy with the results. First of all, it starts with a happy customer. That's the whole Geodrill story. Since the get-go, it's always been about keeping the customer satisfied. And as long as you've got a happy customer, you've got the basic foundations for building a strong business. And at this point in time, I have to say that's all going very well. We've been invited to tender on a lot of works. We've got 2 or 3 very strong bids in at the moment, and if we get some news back on those shortly, we'll be eminently booked out, and we'll be adding rigs to the market there. But it hasn't happened yet, so I can't really talk too much about that just yet.
All right. How many rigs do you have operating in South America?
We have 4 rigs, and currently 2 are operating. And so that gives us kind of 50% utilization. But if we were to, and we need that spare capacity because we would need to provide a soft start on these jobs that we're bidding, and it would require that we actually ramp up. We would need to send more equipment to service these particular contracts. So all in all, it's been a good start. But you'd say, well, 50% utilization, is that a great result? Well, considering we've only been there and still establishing ourselves, we're very comfortable with how it's going for now. Very happy.
And I would think when you enter a new market, you probably want to overinvest in capacity, so when there is demand, you can respond to it right away. So it's a little chunkier. Once you get to bigger rig counts, then you can optimize it better for where the market's at.
You certainly, when you have the larger fleet, you have a lot more flexibility We're just not there with a fleet of 4 rigs. So we need to address that. But we can't go committing more equipment to the market when we've got only 50% utilization. And the other part of that, on the flip side of that, is the existing fleet that we have is all busy. So you wouldn't take rigs out of a market where they're busy, put them in a market where you've got 50% utilization. But the 50%, it'll be short-lived, very short-lived. I'm expecting we will imminently get some news, and I think that there might be something that we could be talking about on the next call. And but for the meantime, customers happy. We're bidding plenty of work. We're being told it's looking good. So let's just see how that plays out. I think it's going to be an interesting play for us.
And one final question: you announce you have 1 and 2 year contracts and some 5-year contracts. How much visibility do you have on your business going forward, and how much of it is sort of short term? Someone phones up and says, "Hey, we need 5,000 meters drilled next month." Does that kind of business show up, or is it more this sort of they've got it contracted and then they give you some heads up on when they want to utilize their contract?
Normally at the beginning of any year, we would have, when we're laying out our budgets for the year, we would typically have an estimation of what our revenues are going to be, and we would split between what is booked, committed, and what is probable or to find. And generally that split is can be 60-40, can be 50-50. At the moment, it's about 90-10. We 90% committed and 10% defined. So we're very confident. We can always say with some predictability where our revenues are going to end this year. And we can actually say with some predictability where we're going to end for the next 5 years, because some of the contracts we've signed are for 5 years. And whilst we don't have visibility out for the full fleet for the 5 years, I do not recall in this company's history ever having 5 years visibility on anything. 2 or 3 would have been the. So that's the point that I'm making here, is it just gives you an idea of the environment, how strong the actual environment is at the moment.
All right. Well, I think that's a great way to wrap it up here. Any final comments before we close things up?
No. Great quarter. Geodrill just continues to just hit the numbers and keep drilling the holes, and to the highest international ESG and HSEQ standards for our happy customers. And hopefully those happy customers will transcend into happy shareholders.
Dave, thank you very much. Thanks for joining us today, and we'll talk to you again soon. Cheers.
Thank you. Cheers. Thank you.